The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Harsh words for Iran and Israel, dovish words for financial markets. Equities back to record highs. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. We're kicking you off to the closing bell right here in the U.S. It's sort of like rewind from just a few weeks ago.
It's almost like the last few weeks never happened.
It is almost like that. You are looking at an S&P a stone's throw away from its closing high, about, say, 50 points away. But the NASDAQ 100 is at a record closing high. VIX down. Still a bid into the bond market, though. That may be a separate issue in a safe haven trade. And also about Jay Powell. And then you have crude just absolutely plummeting. Romaine, energy stocks getting wiped out.
And as we keep an eye on the S&P 500 as it inches its way back to that 6144 level, we should note several individual stocks are already at new record highs. JP Morgan, which set an all-time high back in February before plunging 25%, has now round-tripped and is poised to close at a fresh record today. Similar milestones in the making for other notable names out there: Broadcom, Microsoft, Netflix, Royal Caribbean, Robinhood, and even IBM. Easing Mideast tensions, of course, arguably one of the biggest contributors to the upside swoon, as fears of a global nuclear-tinged war fade as quickly as they swelled. Brent crude back down around 67 a barrel, below where prices were when Israel first struck Iran on June 13th, as the lessened risk of oil supply disruptions lessens the need for a price premium. Gold also back below those pre-missile strike levels, as is the VIX, which drifts back below 18. Now, adding to the positive vibes today are constructive comments from none other than Jerome H. Powell, the Fed chair, suggesting to Congress that lower inflation and weaker labor data could lead to an earlier cut to interest rates, echoing statements that we've heard from other FOMC officials.
I think many paths are possible here, and certainly the one you mentioned is a possible one. We could see inflation come in not as strong as we expect, and if that were the case, that would tend to suggest cutting sooner. We could see the labor market weakening, and that would also suggest cutting sooner. On the other hand, if we see inflation coming in higher, or if the labor market were to remain strong, then we would probably be moving later. So I think a range of possible paths are possible, and certainly the one you mentioned is one of them.
Not only Fed Chair Jay Powell helping to lead the markets higher, but so is nothing terrible happening out of the Middle East and an apparent ceasefire. So this is kind of a crazy chart. It shows where the S&P is versus intraday and record closing high. They're so close to each other, you can barely see the two lines. But you're looking at 61.44 for the closing high, 61.47 for the intraday high. They are both hit on the same day. We are almost there, despite the continued uncertainty, despite a 2-week deadline now for tariffs, which comes in July 9th, and without any concrete peace necessarily in the Middle East, Romaine.
Absolutely. Andrew Slimmon joins us right now, kicking us off to the close here on this Tuesday afternoon. Head of Applied Equity Advisors and Senior Portfolio Manager with Morgan Stanley Investment Management. And Andrew, this round trip that we've seen over the past few weeks really begs the question as to what is driving it. Is this just a sentiment-driven rally? Is it technical, or is there a fundamental case to be made for being back at these record highs?
Yeah, Romaine, here's the fundamental. I mean, you listed two great reasons, the geopolitics coming down and Fed. I'll list another one, which is in the first quarter, companies beat estimates significantly. And if all else was equal, then Wall Street should have raised their full year guidance by at least the amount that the first quarter numbers went up. But they didn't. They cut guidance dramatically. Companies withdrew their guidance, and it really left Wall Street to guess what was going to happen the rest of the year. And so they slashed numbers. And so I think that's another reason why the market's rallying, because the market is realizing that maybe the earnings numbers for this year have been cut too much. Tariffs won't be as negative. And if that's the case, Wall Street will be forced to re-raise their guidance, because the hard data, the actual numbers so far have come in above estimates.
Well, that's what I'm curious about. We have seen a few strategists start to raise their targets, both for EPS for the year as well as the closing price target. But it's only gone up really just a smidge over the past couple of weeks. And the high end of that range, at least as tracked by Bloomberg, hasn't actually budged as well. Do you think you are going to see more folks on Wall Street accept, I guess, at least for what right now we know to be the reality, which is a strong corporate environment, a relatively stable economic environment to boot?
Yes, I do. It reminds me, Romaine, of COVID, which was in the spring of 2020. We had this COVID. Companies withdrew guidance. Wall Street dramatically cut earnings estimates, and then they were forced to, into the second half of the year, raise guidance. I think that's what's going to happen. Just to put a, exact on this, first quarter estimate earnings beat by about $4, but the full year number was brought down by $10. That's $14 delta, Romaine. And I think, and that's just this year. That's not for next year. And that's there's some bearish arguments, but that's the bullish point that I also think is going on here.
Which leads me into Bill Gross and a post on social media on X earlier today. And it was pretty funny. He said he sees a little bull market for stocks, a little bear market for bonds. The idea is that stocks are really AI dominated and are looking at, say, 1 to 2% economic growth despite tariffs and geopolitical unrest. But there's nothing dramatic either way for now. And that is what it kind of feels like on a day-to-day basis in the market. Andrew, what do you think about that? Little bull market, little bear market? Well,
I mean, the bull market for equities, and I'm an equity guy, is that right now the estimate for next year is $300. Well, what happens? I mean, Morgan Stanley just had a financial conference, and every CEO that got up talked about using AI, employing AI. I think this is a 2026 story. Why are they talking about it? Is because it's margin enhancing. And does that $300 reflect that? I don't think so. So that's the upside, is that the E, again, might be too low. Now, the problem we have is that 6,100, you're still looking at a pretty high multiple, and that's why I'm not, incredibly bullish when we're back at 6,100. But I think the fundamental story is turning out to be stronger than what many predicted.
So like a better bull earnings, but a little bear bull market, maybe something along those lines, in terms of what the stocks are actually doing versus what the numbers when they come out. What sectors in that environment do you like?
Well, you have to think about who's going to benefit. Well, technology. Why is, I hear all the time U.S. exceptionalism is over. That's the argument for outside the U.S. I get that, but I think what's really going on here is that the very large, the Mag 7, they're spending a lot of money on CapEx rollout. And they're telling us, Alex, don't worry, this will all pay off down the road. And, we're saying, we'll see. Well, I wouldn't bet against these guys. But right now, their return on invested capital's come down a little bit. So I could see a scenario, Alex, where you get to the end of the year, the rest of the world has done better than the S&P. The 493 has done better than cap weight, and everyone said, oh, it's all over, U.S. exception is over. And guess what? All these companies that start to employ AI are going to, use these services, and you're going to see the S&P cap weight come roaring back next year.
Real quickly, Andrew, I do just want to get your thoughts on the geopolitical situation and, more importantly, the market reaction to it. A market reaction that, of course, has more or less round trip from some of the big fears that we had just a couple of weeks ago to, at least now, based on pricing in the market, it's almost like it never even happened.
Yeah, but I think, Romaine, that's because we've had a series of events over the last 5 years where people sold and it turned out to be a mistake. And I think that's the muscle memory of, I'm not going to make this mistake again. So somewhere along the way, we're going to have some geopolitical event that is going to turn out to be more serious than the market expects. But I think that's why people didn't really sell and we didn't have much of a pullback, because it has turned out to be a huge mistake to react to it over the last few years.
All right, Andrew, got to leave it there. Andrew Slimmon, head of Applied Equity Advisors over at Morgan Stanley Investment Management, kicking us off to the close here on this Tuesday afternoon as we keep an eye on a record run for the NASDAQ 100. The S&P stretching close to its record highs as well. A conversation with Jeremy Siegel, Professor Emeritus of Finance at the Wharton School.
Speaking of a ceasefire, we're going to talk to Kurt Volker, a former U.S. ambassador to NATO, on what's next for the Middle East as President Trump turns his attention now to NATO for its annual summit.
And from The Hague to the world of emerging markets, a discussion on where to invest across the globe. Ruchir Sharma, founder and chief investment officer over at Breakout Capital, will be joining us a little bit later in the program. You don't want to miss it. Stick around. This is The Close on Bloomberg.
Stocks a stone's throw away from their all-time highs. You have the truce between Israel and Iran holding, and also you have Fed Chair Jay Powell testifying before Congress that many paths are possible with regards to a July rate cut. I want to bring in Jeremy Siegel, Professor Emeritus of Finance at the Wharton School of the University of Pennsylvania. Professor, always good to see you. Is the pain trade now to the up or to the downside?
I think the tendency is definitely up. The trend is up. I mean, you know, if the ceasefire holds, it looks good now. That's a tremendous plus for the markets. I think, you know, all-time highs for the S&P are virtually a foregone conclusion now, and further highs after that. I mean, Powell was flexible. Clearly, Congress wants interest rates to go down. A number of Fed officials do. That could be a positive. I think they should go down also. So with the Mideast developments, with AI, as Andrew, your previous guest, pointed out, I mean, the artificial intelligence revolution is just in the early stages. I think there's a lot of positives for this market.
So if we just go back a week or 2 weeks ago, when an Israel-Iran conflict was not even on anyone's radar, stocks are still above the level we were then. So fundamentally, what's actually driving the market?
Well, you know, I mean, you know, if we have a non-nuclear Iran, if there is a ceasefire that now takes out, you know, the possibility of a major oil disruption, I would still like to see the Houthis neutralized so that we can get shipping around the Red Sea, and that would lower costs also. But all that would bring down the temperature in the Mideast dramatically, and maybe normalize relations in that oil-rich area. So, I mean, I think certainly the developments are positive. Also for the United States. I mean, this was, I'm a little older. I remember 45 years ago when our helicopter crashed in the desert storm, and trying to rescue some of our diplomats caught in Tehran. It was a tremendous embarrassment for the United States for years. I mean, this was executed extraordinarily well. That sort of power image, I think, is also not lost on China with respect to whatever ambitions they might have on Taiwan, which would also be a favorable development in that direction.
I am curious, though, when we talk about, Professor, this idea of a market that at least has found some comfort with, I guess, the chaos that is out there, whether it's in the Mideast or even back here at home. Jay Powell was on the Capitol Hill today, obviously peppered with a lot of questions about rate cuts and the state of the economy. He seemed to suggest, as he clearly usually does, that the economy is in a good place. But he also seemed to be finally sort of echoing the comments that we've heard from other FOMC members, this idea that should there be a need to cut rates, and in their view, they think there might be, they are ready to do so, and relatively soon. What did you make of his comments?
Yeah, I thought he tilted a bit more on the dovish side. I mean, I agree with Waller, Bowman, Austin Goolsbee. I mean, I think that the Fed is in a restrictive stance. I think that now that the oil is, you can see the big drop, as you said, actually, I think lower than it was on the day before Israel started the bombing of Iran. Home prices, now not many people commented. I watched the Case-Shiller home price index very closely, and the FHFA index. Home prices are beginning to fall. This is, shelter is 40% of the core CPI. And as Powell mentioned on Capitol Hill today, they come in with really big lags. We're beginning to see the declines on the top end that is going to feed in the next 12 months a negative rate of inflation. if firms use AI, they can. I'm not saying they can offset all the costs. I doubt that the Trump tariffs are going to impose, but I think they're going to offset some of them, and perhaps more than a lot of people expect, so that inflation fear is lessened. Secondly, I don't think that whatever the inflation from the tariffs, the Fed should act on a tariff-caused inflation. That's like a tax, and it's not an excess demand situation, which the Fed needs to act on. Yeah. It's just a tax. We can see through it. It's a one-time bump, assuming, again, I'll say the one thing: the market is assuming that the current level of 10 and 30, 10 base, 30 for China. Now I know aluminum and steel are higher. Basically, that's going to hold, and that we're certainly not going anywhere near back to those, Liberation Day tariffs. If we do, all bets are off, in my opinion.
All right. Well, I guess we're going to find out some more on that front in a couple of weeks with that self-imposed July 9th deadline. Professor, always a pleasure. Professor Jeremy Siegel from the Wharton School, as we keep an eye on stocks, equities right now hitting fresh session highs. We should point out the S&P just a little while ago scraped 699.98 here. So a flirt with that 6,100 level, and some of the big movers on the day. That includes the folks in the cruise line space. Carnival shares, one of them, cruising higher on the day after it reported results prior to the bell. Breakdown of what we learned, and more importantly, what to expect, coming up next in our top calls. This is Bloomberg. She's right. Time now for our top calls. Big movers on the back of analyst recommendations, and we start off with Meta. Citi boosting the price target to 803 from 690, maintaining a buy. The firm saying engagement continues to improve, and it has a positive outlook on Meta's AI and advertising innovation efforts. That two-day run right now for those shares, 710.70. Right now, just about 20 points or so from another record high. Next up, let's take a look at Advance Auto Parts. Goldman hitting the brakes on the stock, downgrading to sell. The analyst saying third-party data suggests the retailer is losing market share, and the company's margin recovery story may be in jeopardy. Those shares down 8.5%. And finally, Lyft. TD Cowen lifting their rating to buy from hold. The company calling Lyft the best mid-cap idea for 2025. The analyst says they see multiple growth levers for the stock, and you see the shares moving higher by 6.5% up for a second day, and those are some of our top calls. Let's turn now to Carnival. Those shares on a 4-day run up 8% on the day after the company raised its full-year profit outlook, saying cruise demand, well, it remains strong despite the economic uncertainty. Sharon Zackfia joins us right now, head of consumer equity research at William Blair. She has an outperform on the stock. All right, I feel like this is never a surprise with this company. We always sort of look at Carnival and these other cruise line stocks, and we assume there must be some downturn coming, and we kind of forget there are these like cruise nuts out there, including several in my family, who are just going to buy tickets and go in these cruises no matter what economic conditions. Is that what's helping the company right now?
I mean, I think it's more than just the cruise nuts to have kind of an upside that we saw here in the second quarter. I think what we're really seeing is the value of cruise really show through here. I mean, cruise came back to the party late, right? The industry was shut down for quite a while during the pandemic. They've been raising prices, but they missed out on a few years when land-based was raising price. And the gap between cruise and land is meaningful. We have a consumer that's discerning, they're looking for value, and cruise is there for them. And I think we're seeing a lot of new to cruise, actually, within the strength that we're seeing in 2025.
Talk about that differential between the cost for taking a cruise versus doing a traditional land-based or taking a flight somewhere and doing a land-based trip. What is that gap? What does that look like?
Yeah, I mean, it's a hard thing to measure. Typically, we'll measure against a Disney World or a Las Vegas. If you look against those kinds of vacations, the gap is probably still 15-ish% relative to comparable land-based. It was as high as like 25%, 30%. So they are closing the gap. But if you look pre-pandemic, that gap was single digits. So it's still a more meaningful gap today. And I think importantly, the cruise experience is as good, if not better, than it was in 2019. And you can't say that about a lot of hotels these days.
So, Sharon, is this a Carnival-specific story or an industry story?
I mean, I think we're seeing broad-based strength. You know, we had Royal report their different quarter. You know, Norwegian and Viking are out there, and everyone's kind of having good results. I think there are differences in the demographic profile of some of those companies that I mentioned, but certainly the big bellwethers, Carnival and Royal, have been doing very, very well.
So then how do you distinguish as an analyst, like, which one's better? Because if it's an industry trend and just basically broadly competitive to land-based vacations, how do you determine which you want to buy?
Yeah, and I think the goal is to gain share against land-based vacation, and that's a really big difference than maybe the arms race the brands were in, you know, 15 or 20 years ago, where they were trying to kill one another. Now it's how do we get more share, right? And it's a much more rational, competitive environment because of that. And I think that's part of what's rewarding the overall space. In terms of which stocks you want to buy, I mean, there are obviously different market cap ranges and so on. We have outperforms on both Royal and Carnival. We like both. I think, you know, Royal has tended to be the leader in this space. Carnival's playing a little bit of catch up. They had to take on more debt to survive the pandemic, but they're now within a notch of investment grade. And I think after that, we start to see the dividend come back at some point, perhaps as early as 2026.
All right, Sharon, thanks a lot. We really appreciate it. Sharon Zackfia, head of consumer equity research over at William Blair. There are some reports coming out, the latest from the New York Times, saying that U.S. bombs didn't collapse underground Iranian nuke buildings. They're citing preliminary classified U.S. report on Iran action. CNN also saying something along the same lines earlier as well.
Yeah, and a lot of moving parts in this right now. Just a little while ago, we did hear from officials in Israel, including the defense minister there, who said that they will respect the ceasefire as long as Iran does so itself. And then Benjamin Netanyahu, the prime minister, also speaking, saying that in his words, he's declaring victory and says that Israel would act again if Iran did try to renew its nuclear project. So still, despite some of the big and bold statement we've heard out of the United States, there's still a lot of unanswered questions as to what damage was actually done to those Iranian sites, and more importantly, is there really a ceasefire going on right now? And
if you look at U.S. equities as a barometer for fear or not, they're sort of ignoring any potential bad news. They're up by about 1.2%, have you been pointing out, are really close to the highs of the session. Whether or not that's the right barometer remains to be seen. But investors not really reacting at all.
Well, and maybe one reason is oil is still flowing, as far as we know, through the Straits of Hormuz. No major energy infrastructure that we know of has been harmed in this whole battle. So at least for right now, it's kind of a status quo situation, at least as far as trade flows go.
Yep, and we're going to talk about that much more right after this. As the NATO summit gets underway, we're going to break all of this down with Kurt Volker, former U.S. ambassador to NATO and former U.S. special representative for Ukraine negotiations. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Alex Steele. Markets holding steady, but the headlines really fast and furious now. So findings from the New York Times citing classified findings indicate that the attack by the U.S. to Iran sealed off the entrances to two facilities, but did not collapse their underground buildings, and that it sort of set back Iran nuclear program remain by just a few months. And that's been really the question mark here, is it how much damage did those bunker-busting bombs actually do? Well, let's get more right now with Bloomberg's Balance of Power co-host Kayleigh Lyons joins us. Hey, Kayleigh, what's the response from the White House so far?
Well, the White House, obviously, and more specifically President Trump, as well as other officials like the Vice President J.D. Vance and the Defense Secretary Pete Hegseth, have said repeatedly that the U.S., with the strikes over the last weekend, completely obliterated Iran's nuclear program. Obviously, this reporting, not just from the New York Times, but CNN as well, seems to fly in contrast to that, as both are reporting that the program was only sent back a matter of months. CNN, citing officials familiar with the matter, pointing specifically to an intelligence assessment from the Defense Intelligence Agency, which is in the intelligence arm inside the Pentagon, that said the core components of the program were not destroyed, likely only sent back for by a few months. And when asked by CNN for comment, the White House press secretary Caroline Leavitt did actually acknowledge the existence of that assessment, but said in the mind of the White House, it is flat out wrong, was classified as top secret, though still leaked to CNN, going on to say the leaking of this alleged assessment is a clear attempt to demean President Trump and discredit the brave fighter pilots who conducted a perfectly executed mission to obliterate Iran's nuclear program. Again, using that obliteration language, even though these assessments that the New York Times and CNN have now seen, which Bloomberg has not independently verified, would suggest that, in fact, it was not complete obliteration, that actually this only may be, frankly, a minor delay in the Islamic regime's nuclear program.
Yeah, and how can a report be wrong and yet also classified at the same time is also a little confusing. Kayleigh, thank you very much for jumping on those headlines for us. Kayleigh Lyons of Bloomberg's Balance of Power. Let's get more on this with Kurt Volker, former U.S. ambassador to NATO and former U.S. special representative for Ukraine negotiations. Ambassador, clearly you haven't seen these headlines. They're just crossing as we are talking. What do you make of them if those bombers, the most powerful bombers in the world, aside from a nuclear weapon, can't destroy these facilities?
Well, I think it's too early to be making any definitive judgments. These are some initial intelligence reports. I think they are still waiting for more information themselves. And I think the issues here are partly what were the bombs able to destroy underground. You know, we're talking hundreds of feet underground. And that's really only going to be verified by what human intelligence can figure out once some people collecting that intelligence are able to get there or to get information from those who know. And secondly, what were the Iranians able to move away from these facilities before the strikes took place? We simply don't know that either. So there's a lot that we've yet to learn. But I think at a minimum, there is clearly some significant damage to the buildings, to the ability to use the facilities. And that will set back the program for some time, to some degree. And if Iran indeed continues to pursue a nuclear weapons program, if they kept the enriched uranium and the weaponization capability, I think you would see both the U.S. and Israel then start looking at more strikes again.
I am curious as to what you think, Kurt, is the appetite for more strikes. And I mean that from the U.S. angle. I mean, the president seemed to suggest a little bit earlier today that he had basically given Israel and Netanyahu all the help that he was willing to give. But do you envision a realistic scenario where we would be more actively involved in additional strikes against Iran?
Well, it's clearly not something that President Trump wants to do or wanted to do initially. But after Israel launched this war, I think Iran had both the motivation and the means to move to a nuclear weapon very quickly. And the only way to prevent that was to launch these strikes. That, I think, has set things back. But I think we're now at a stage that Iran will be very highly motivated to develop a nuclear weapon and to use it if they can. And that needs to be prevented. So appetite or not, I think that we are going to be in a dangerous phase if Iran is actually in the position to develop another nuclear weapon soon.
And this is, of course, the backdrop to that NATO meeting in The Hague as President Trump just arrived. Having been the former ambassador to NATO, how does NATO wind up looking at something like this? Like, no one's going to be upset that Iran doesn't have a nuclear weapon, right? Everyone's going to love that, yet they might not love Trump.
Right.
How does that work?
Yeah, so it's a couple of things. First off, as you said, no one in NATO wants Iran to have a nuclear weapon. So if this was successful, they're going to be happy about that. They weren't happy about launching the war to begin with, but now they will be quite content with Trump's efforts to now promote a ceasefire and get that ceasefire to hold. So he's going to get a lot of credit, a lot of praise from people at NATO, also because they want to create a positive atmosphere for President Trump. They're concerned about possibilities that Trump may reduce America's commitment to NATO, whether it's following through on Article 5 or U.S. troop presence. So they want to make sure that he understands, he feels that the U.S. role was appreciated, that he knows that Europeans are doing more on defense spending themselves, and that they make this a very positive meeting for President Trump.
With regards to this meeting, obviously what's happening in the Mideast is going to be a big topic of conversation. But of course, the unresolved issue with Russia and Ukraine, and drawing on your experience and your former job and the advice that you would have to give the presidents, is there an end game here? And I don't mean that in the sort of like, what is the definitive end to this war? But I mean, what could the U.S. do, or what leverage do we have to try to sort of curb what has now been going on for way too long?
Right. There are two things that need to happen, in my view. The first and the most important is to make sure that there is a steady flow of military assistance to Ukraine, equipment and ammunition, so that they can continue to defend themselves, to have air defense, shoot down the Russian missiles and drones, protect the population. And Putin needs to see that there is a lot of equipment and ammunition. There's an endless supply of this. He will never succeed in defeating Ukraine. We have the resolve and the will to make sure that Ukraine survives. And this doesn't have to be taxpayer money. This can be paid for. It can be paid for by loans to Ukraine, a lend-lease deal for Ukraine, where they borrow the money from the U.S. Treasury, pay us back later, and only use the money to buy American weapons and ammunition. That's one way. Another is take the frozen Russian assets that are mostly in Europe, seize those assets and use it to buy weapons. Or another way is for Ukraine to borrow money, or your European Union countries to provide the funds to buy the American weapons. But we've got to demonstrate to Putin that we're not just walking away from Ukraine, and they're not going to fold. There's plenty more where this came from. The second thing is we need to tighten up the sanctions on Russia to dry up the revenue going into their state budget. They are getting most of their state budget revenue from oil and gas sales around the world. We have let the sanctions be evaded. We need to tighten up secondary sanctions on those who are helping Russia to avoid the sanctions. And this is where Lindsey Graham has proposed legislation in the Senate already that would do this. I think we need to see that legislation approved and implemented, and we need to get another one on the books for Lend-Lease for Ukraine to provide the weaponry they need.
All right, Ambassador, appreciate your time. Ambassador Kurt Volker, former U.S. Ambassador to NATO and former U.S. Special Representative for Ukraine negotiations. And of course, you just saw the President of the United States just a few moments ago walking up the stairs here for that NATO meeting in The Hague, Netherlands. Meanwhile, back here in New York, we refocus on the big stocks that are moving on the day, and a lot of discussion right now about the robo-taxi rollout. You've seen that reflected in shares of Tesla, and now you're seeing it reflected in shares of Uber. That's our stock of the hour, and it's up next. This is The Close on Bloomberg. Time now for our stock of the hour. Taking a look at Uber. The share is up more than 7% as it starts to offer driverless Waymo rides in Atlanta, Georgia. Mandeep Singh of Bloomberg Intelligence joins us right now to talk a little bit more about, I guess, the burgeoning market for autonomous ride sharing. I mean, I know these things kind of exist already. You see them in LA, Vegas, San Francisco. Apparently they're coming to New York. And Tesla just had its big robo-taxi debut, if you will, down in Austin, Texas. This is real. This is a real market?
It is real. Yeah. And just to put it in context, right now, Waymo is doing about 50,000 rides a day. Compare that to Uber that is doing 9 to 10 million rides a day.
Wow.
So still, I mean, there's a lot to catch up.
Yeah.
But clearly, with Tesla launching in Austin, the technology is there. The question is how quickly the use cases will come. And my thinking around here is for airport rides, you're not going to take a Waymo. Just you have so much luggage. I mean, unless you're traveling light.
Yeah.
And, you know, for certain non-emergency medical rides, probably Waymo isn't the best option. You're still going to need a ride with a human driver. So certain use cases, especially in dense metros, can be solved for using a Waymo. But I don't think it's going to address the 9 to 10 million rides that Uber is doing every day. That's why they're partnering.
So you guys have a note out of Bloomberg Intelligence that robo-taxis are going to really grow the ride-sharing market. To what and why? Like more people are going to come in and take them because they're driverless?
Yeah, so right now this market is around $180 to $200 billion, predominantly, you know, Uber and Lyft, and then globally in China you've got different players. our expectation is this market will expand low teens, but with autonomous, you will have more supply. And what it's going to do over time, once it's become, 1 million miles a day, that's when the cost per mile will come down and people will start taking that more. But it's just going to add 100 to 150 basis point in total market growth. So it's not like the market is going to double because of autonomous.
Well, I'm glad you brought up the word cost, because I am curious about how much this does cost. I mean, the Waymo vehicles, I mean, at least if you go on full MSRP, I mean, these are basically $100,000 SUVs that they're then outfitting with, God knows how much money in cameras and other equipment here. When does this become cost effective, assuming that I'm not going to have to pay, triple what I would pay for a human ride?
I mean, right now, people have a preference for Waymo rides, so they are willing to pay up, and clearly that's working in their favor. But in terms of costs coming down, it's alliances. Waymo isn't going to manufacture their own cars like a Tesla is doing, so they're going to have more OEM partnerships with your Toyota and Hyundai and all the other car makers. And over time, the component costs, like the big difference is Waymo using a LiDAR and Tesla just relying on cameras. Well, the LiDAR costs are coming down, and everyone wants to collect more data. So in a sense, Waymo is collecting a lot of data using all these sensors, which will eventually help them make their AI better when it comes to autonomous driving. So maybe it's all the upfront investment in collecting data.
I like the Waymo cars because they're cool looking, and I think that should be the strategy. They should only do like cool looking cars.
I'm still terrified. I don't know.
So, or maybe
it's hard to break the habits.
Or maybe bring
That's
back
why Uber is so kind of sticky, because you can't break your habit. You can't say, "Oh, Waymo is here. Now let me pull up Waymo app." You're still gonna pull up Uber app because it's
I even
ubiquitous.
have a hard time like arbitraging between Lyft and Uber. That's like too complicated for me. All right, Mandeep, thanks a lot. Mandeep Singh, Global Head of Technology Research at Bloomberg Intelligence. We're 15 minutes from the closing bell right here in the U.S. This is Bloomberg.
I could see a scenario, Alex, where you get to the end of the year, the rest of the world has done better than the S&P. The 493 has done better than cap weight, and everyone said, "Oh, it's all over. U.S. exception is over." And guess what? All these companies that start to employ AI are going to, use these services, and you're going to see the S&P cap weight come roaring back.
And that was Andrew Slimmon over at Morgan Stanley Investment Management, kicking us off to the close just about 50 minutes ago. And just about 20 minutes ago, the S&P 500 hit its high for the day, back briefly above 6,100.
I mean, we're really close there, holding on to the gains despite different reports from the CNN and the New York Times over what was destroyed in the U.S. bomber attack on Iran's nuclear facilities. Also, though, taking a look at the NASDAQ 100, that is now sitting over a record closing high. So get out those bells and whistles here, as everything's really higher except for energy stocks.
Absolutely. And of course, what's leading the charge? It is a lot of those big tech names, particularly in the Philadelphia Semiconductor Index. That's having a great day. Names like AMD getting strong bids. So too is Micron, which reports later in the week. As we move closer to the closing bells here on this Tuesday, let's bring Youngyu Ma into the conversation, Chief Investment Strategist at PNC Asset Management Group. And Youngyu, we do want to start off with what I guess we'll just call a record rally, for lack of a better phrase. It's just the NASDAQ 100 right now. But I want to talk about just the impressive round trip that we've had, going back, of course, to those lows that we saw back in April, which of course intensified to a certain extent in May, surrounding a lot of questions about where we were going with trade, where we were going with geopolitics. And right now, if you had been asleep at the wheel for the last 3.5, 4 months, it almost seems like nothing actually happened.
Yeah, thanks. It's great to be here. Well, a lot has happened. There's still a lot of concerns that are in the air and a lot of plates spinning that people are concerned about. But if we think about the main drivers of the market, we do see a lot of factors coming together. It does look like the pass-through to inflation from tariffs is going to be quite low, at least much lower than people were fearing in the beginning when tariffs were announced. Additionally, we do think the Fed's still on track to cut interest rates, and the market is looking forward to that as well. And business spending, we think, will get a big jolt from the fiscal budget that will be passed in the coming weeks. So we think if we look past even further out toward the end of the year, a lot of these factors are coming together in a favorable way. And some of the big concerns, they're still there, but it does look like they're being held in the balance and not really coming to the fore to damage the economy or markets.
So when you hear commentary from some of the FOMC members who seem to suggest that rate cuts are not only needed, but needed sooner rather than later. And Jay Powell today on Capitol Hill, at least in the Jay Powell way that he speaks, seemed to actually suggest that he might actually be on board with that. You think that's going to happen?
We do think that's going to happen, and those projected rate cuts did remain in the Fed's recent summary of economic projections just recently. So we think that's on tap to happen. We do think that the Fed ultimately still does see interest rates as restrictive. Certainly the housing market has been stalled. But I think the Fed does want to give a little bit of caution to make sure there's not going to be a surprise pass through to inflation from tariffs. But I think the Fed is gaining more and more optimism, just like the markets are, that if we were to have seen pass through from tariffs to inflation, we would have already seen it. And I think that that's something that investors are starting to understand and key off of now.
Really? Because it seemed like Jay Powell was saying it was going to be June, July is when the impact were really going to hit when it comes to pricing.
Well, I think he's saying that to be cautious, and he does want to see a little bit more data. But think about what happens when oil prices jump. If the companies have pricing power, they pass those through immediately. And even though these companies are seeing disruptions to their supply chains, additional costs in certain areas, there's not a lot of pricing power to pass these on to end consumers in many cases. So a lot of times they have to figure out where in the supply chain this is going to get absorbed. So yes, definitely there's potential for some price increases in the coming month or two or coming months. But we don't think those are going to be extreme. If those are going to be significant, we'd have already seen them start to show up in prices.
Okay, so then from that perspective, though, how do you think of sectors? Like, do you still want to avoid, say, consumer staples because they might see that margin impact more?
Well, let's talk about what we like first. We like industrials, we like construction, we like engineering, we like communication services. A lot of these things that play into the build out of U.S. manufacturing, the build out of AI, the energy needs, the infrastructure needs. We think there's a lot of money and investment that's still going into these areas, and the fiscal package or budget that will be passed does actually accelerate some of that in terms of the stimulus that'll be in there and the tax breaks for that investment. So that's an area where we think a lot of money is still flowing. Now, where could we see challenges? Perhaps staples, perhaps the consumer staples, the safety trade for consumer staples, it tends to keep those valuations elevated, is probably going to be less pronounced now when some of these concerns start filtering away from the market. And there could be margin pressures, right? A lot of these companies do work on slim margins. Same with consumer discretionary. If there are some more strains or continued strains to the lower end of the income spectrum, that could also suffer a bit. So there are select areas that we could see profit margin pressure happening, but these big areas of spending and investment we think are holding up well.
Just real quickly on the consumer side, I mean, we did get some consumer confidence data today that did show a deterioration in the outlook for a lot of folks out there. And then on Friday, we are going to get that PCE data, and economists are expecting to see a slowdown in both personal spending and personal incomes. When you look at the consumer into the rest of this year, Young-Ya, do you think that's actually going to hold up? Do you think they are going to hold up and support this economy?
We do. We think that consumer spending will remain stable. Consumer confidence doesn't have a lot of flow through to spending. And in fact, probably a lot of what you saw in those consumer confidence numbers, the survey was taken during the period when the conflict was acute in the Middle East. And we think that probably impacted the numbers a bit. And that's one of the main drivers there. In terms of personal incomes, personal spending, that's been holding up reasonably well. We think it will continue to hold up. And there will, yes, continue to be strains at the lower end of the income spectrum. That's showing up in the data as well. In terms of delinquencies, you see that as well. But if you think about where the actual drivers are, where the bulk of the spending is, that should hold up reasonably well here.
Young-Yu Ma, got to leave it there. Chief Investment Strategist of PNC Asset Management Group, counting us down to the closing bells. Those bells just about 3 minutes away here as we look at stocks pretty much right around session highs, and a lot of companies today, Alex, hitting fresh 52-week highs and quite a few hitting fresh record highs.
I mean, we're well above now, sort of retracing the losses since Israel started bombing Iran on the 13th. We're now above those levels. We're below those levels when it comes to oil, and that really is a head scratcher. There's fundamental stuff going on.
Yeah, we're back to levels pre-Iran or Israel. We're back to levels pre-Liberation Day. We're almost back to levels where we were back in early February when the market was dancing on the ceiling.
Dancing on the ceiling, yeah, and we had the tariff deadline. No, I don't. You know I don't do song. You know I don't do. You know I don't do that kind of stuff. Okay, anyway, point being, you have the 9th of July. That's the tariff deadline.
4, 3, 2, 1.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Steele, taking you through to that closing bell with a global simulcast that starts now. Scarlett Fu in the TV studio, Carol Masser and Tim Stanovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. It's great to see you guys illuminated for a change here on a day where the market is touching fresh or close to record highs.
I mean, this is one of those things I'm like, well, what has fundamentally changed? Can we really count that like everything has calmed down in the Middle East? I'm thinking about this report that's just, preliminary findings of the U.S. strikes in Iran, whether or not the nuclear enrichment capabilities have been as damaged as we've been hearing maybe from the White House. I just feel like there are still so many questions out there, but hey, everything's awesome today.
Yeah, investors certainly thought so. And we did see a little ever so slight pullback at the end of the day, perhaps on that report from the New York Times, but really surprising to me that, and maybe because it's preliminary, we just had a great conversation with Adam Ferrara down in Washington, D.C. It reminded us, look, this is a preliminary report. It's what we know so far. That if these sites weren't destroyed or at least damaged as much as people had thought, then that program isn't as set back as people had thought, and perhaps there could be more skirmishes moving forward.
I think there are a lot of people expecting a lot more skirmishes anyway to move forward. But right now, what we have is calm for the moment. And investors seem to have gotten comfortable pricing in a lot of uncertainty. And what we know right now is there's just going to be more uncertainty.
And others would say it's just growth. You got real fundamental earnings growth. It's still there. We're underpricing what the potential growth going forward.
All right, well, at least for right now, the market's taking it in stride. You can look across all of the tapes. You have almost 200 companies hitting 52-week highs and several hitting fresh record highs. That includes names like Broadcom, Microsoft, Netflix, and IBM. The NASDAQ 100 would close at 22,175 on February 18th, its last record high. Well, it surpassed that here on the day. The NASDAQ 100 closing at 22,190, up about 1.5%. The NASDAQ Composite up 1.4%, still has a ways to go to get to its record high. The S&P 500, which briefly traded above 6,100, closing at 60.92 and change, up 1.1%. 61.44 and change is your all-time high. The Dow Jones Industrial Average up more than 500 points or a percent on the day, and the Russell 2000 keeping pace, up about 29 points or 1.3%.
All right, we've got about 376 names in the S&P 500 higher today, guys, 123 to the downside. And Scarlett, we're now up about 3.6% on the S&P for the year.
Yeah, pretty incredible. Let's take a look at the sectors and how they performed. You have 11 sectors in the S&P, and only 2 of them declined today. Energy lower by 1.5% as oil prices slumped for a second day. Consumer staples, little changed on the day. The best performers are technology, led by chip makers, financials also higher, and communication services all gaining at least 1.4% on the day.
All right, a lot of green. I'm going to get to some big ones. Carnival was a bigger gain. I think at one point it was the number one gainer in the S&P 500 earlier in this session, finishing the day with a gain of about 7% off its highs. At one point it was up as much as 10% today. The company coming out, the cruise operator, boosted its adjusted earnings per share forecast for the full year, and it really did lift the entire group. So we saw a lot of peers rising as well. There were some fears, if you go back about a month or so, maybe some concerns about some of the unrest, some of the tariffs, the trade, and about some of whether or not that was going to cut back on consumer spending. But we did see Carnival come out in a big way today. Advanced Micro Devices, number 2 gainer in the NASDAQ 100. It's up about 7%, just under 7% in today's session. You might remember yesterday we did have one Wall Street skeptic turned into a bull with its progress, or looking at the progress of AMD in AI chips and computing systems. We're talking about Mideast research analyst Ben Reitzes upgrading AMD. That was yesterday to a buy from hold. He also raised his price target to 175 from 110. So we did see AMD up about 1% yesterday and adding that 7% gain in today's session. And then Uber Technologies up about 7.5% in today's session. Today beginning offering its customers driverless Waymo rides in Atlanta. So that makes it its second market after Austin. The two companies teaming up instead of competing competing against one another. So Uber definitely one of the outperformers in today's session. Tim.
All right, let's go to some of the underperformers. I want to start with Tesla. On a points basis, the worst performer in the S&P 500. 2.35% to the downside, giving back some of yesterday's gains. Remember, that stock was up more than 8% yesterday after the company rolled out its long-promised driverless taxi service to a handful of riders in Austin. Well, today shares fell. U.S. auto safety regulators are actually investigating incidents where Tesla's self-driving robotaxis appeared to violate traffic laws during the company's first day offering paid rides in Austin. Once again, shares now down by today 2.4%. I think we got some.
Let's take a look at FedEx. The shares they are moving lower in the after-hours trade. Their earnings just now crossing the wire, with the company saying that its adjusted income in the fourth quarter coming in slightly above estimates, $2.02 billion. That was the operating income figure. The street was looking for 1.91. Adjusted EPS $6.07. The street on average was looking for $5.81. On the revenue side, $22.2 billion, and that also is a beat. Here's your guidance going forward. The company says first quarter revenue will grow flat to 2% is the guidance that they're giving for first quarter revenue growth. The company says first quarter adjusted EPS should come in at a range of $3.40 to $4 even. The street on average was looking for $4.03. So that looks to be a little bit of a miss when it comes to its outlook. The company also saying that it's not giving a full year profit view, guys, due to uncertain global demand. And you see the shares bouncing around from losses back to gains.
And a part of the FedEx story right now is really what it does with costs and how it contains those expenses. It's worth noting here that FedEx sees its 2026 capital expenditures at $4.5 billion. Analysts were looking at somewhere in the neighborhood of $5.01 billion, so just over $5 billion. FedEx is going to be spending less in the coming year than what analysts had anticipated.
Yeah, we've seen both FedEx and UPS having a tough time. FedEx is down about 18% year to date. UPS is down about 20%. And I'm just doing a quick check on UPS in the aftermarket. I think initially it was a little bit lower. It's up about 0.5%. So we'll continue to track them and look for some more color, certainly about FedEx. But yeah, that's a big red sticky, not giving fiscal year profit view due to uncertain global demand. So I want to know a little bit more about what that uncertain global demand specifically is.
Yeah, shares down about 1%, but bouncing around in the after hours right now. Wait for commentary on the call as well. I want to get back. Oh, go ahead, Romain.
Yeah, I also just want to point out, too, that, and we should just acknowledge also the passing of Fred Smith, who of course, was the founder of this company. And they actually lead off their press release with a nice commentary about their late founder. Sorry about that, Tim.
Go ahead. No, it's all good.
Yeah.
Okay, let's go back to some of the decliners. I mentioned Tesla. I do want to talk about RTX, formerly known as Raytheon. We did see shares of defense companies fall today. RTX down 2.72% today. Among the worst performers in the S&P 500, defense stocks broadly declined as tensions appeared to cool in the Middle East. And finally, Circle Internet shares fell by more than 15% today. It turns out this stock also goes down. It doesn't just go up. The company's,
I think it's the fourth time since it went public that it's gone down.
Shares are up close to 620% since that June 3rd IPO, but down 15.5% today. It was initiated at Compass Point Research and Trading with a recommendation of neutral. The concern is competition is expected to increase after that legislation here in the U.S. was passed. Once again, Circle down 15.5% today.
All right, I'm taking a look at the bond market, guys. Pretty well bid all across the board, pretty much the whole day. That front end coming in by about 5 basis points, the back end coming in very similar as well. A couple things happened. One, you had Fed Chair Jay Powell making no news, so that helped. Two, you also had two-year bond auction, went on without a hitch. Demand was actually quite strong. You had a ton of Fed speakers today. Fed Governor Michael Barr, the latest, saying that he does expect inflation to rise due to tariffs. The second round effects could make tariff inflation persistent. So sort of, again, talking about the different splits on how to look at tariffs when it comes to inflation. I want to point out we get 5-year auction tomorrow, and then we get a 7-year. So together we get like $104 more billion coming over the next 48 hours. I
got to say, this has been a lot of stuff coming at us. I know that this, I'm just kind of a little dumbstruck here. I don't know if you guys
I love
saw.
when Carol's dumbstruck.
It's been a long day.
It's been a long day. I think you guys are talking about this story. I just want to bring it up. When I read in this morning about this ex-CFA Institute executive charged with embezzling millions, all I could think is, like, if somebody knows how to embezzle, it's probably somebody who has
Carol.
These, like, I'm just saying, right, knows how to kind of maybe.
It's serious business.
Perhaps
I know.
Well, it's only charter holders. as the only charter holder here, I would just say this was a little bit of a shock that this actually occurred and that occurred for so long. But at least they flushed it out.
Just for the purposes of our viewers and listeners, level 1, level 2, level 3, Romaine, where are you?
Yeah.
Oh, he has it.
He's done it.
You've done it. Okay.
How dare you?
You've passed all.
I mean, when I passed, you didn't see me like parading around the office with my charter above my head. You must have been off.
Did you learn how to embezzle?
No, you learned the exact opposite. It's called ethics.
Oh, wait.
Makes up a huge percentage of the test.
Did the guy, though, have a CFA? He was the CMO of the CFA, but did he have a CFA?
That's my point. Like, did he? I don't know. Was he level 1? Did he pass?
You guys are getting us.
That's a good point. That's a really good point.
Right?
But congratulations, Romaine. Good job.
Thank you.
It's like a couple years too late.
That's actually what this is all about.
It's too late, but okay.
All right, I think we have to wrap. All right, that'll do it.
Romaine slays.
All right, that is our cross-platform radio, TV,
That was just for
YouTube,
you, Alex.
Bloomberg Originals. We do it across the board. All right, Alex is heading out for the day, and of course, Scarlett and Romaine continuing on TV. We will as well on Business Week. All right, we'll see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television. Fedex shares bouncing around from gains to losses and back to gains again and now back to losses. A full breakdown of what we learned in that earnings statement and more importantly, what we might learn on the conference call. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick. We've been talking a lot about what would propel this market back to record highs. And, well, it looks like we're starting to get an answer. The NASDAQ 100 did close at a fresh record high, its first record high since mid-February. The S&P 500 rallying about 1% on the day. It still needs just a little bit less than a percentage point more to get back to its record high, which is right around 61.44 and change. You saw the drop in yields, you saw the drop in Brent crude, and you saw the drop in VIX. This is a risk-on sentiment story right now, Scarlett, as a lot of people pricing out the worst case scenarios.
Yeah, it feels like this market just wants to go higher. Let's pinpoint a couple of individual equity movers. We're starting with Uber, rising as much as 8.5%, closing up 7.5%. The ride-hailing company says it's now offering driverless rides through Waymo of Alphabet in Atlanta. Its competitor Lyft also gaining by about 6%, and this is after TD Cowen upgraded that stock to a buy, saying there are multiple growth levers, including international expansion. And Circle, which we usually cite as a gainer because it's done nothing but gain essentially since it went public earlier this month, but this is a rare day of losses for the company behind the U.S. dollar stablecoin. And this is after Compass Point Research began coverage of the company with a neutral rating, the equivalent of a hold, saying that competition will likely increase after Congress passed the legislation on stablecoin. Now, let's get to our top story this hour, because after 12 days of war in the Middle East, a fragile ceasefire is now in place. The early hours of the truce were rocky. You had reports of attacks by Iran and then Israel. That led President Trump to drop the F-bomb in his comments. But things have since calmed down, and the market reactions underscore the de-escalation. The S&P 500 now back to making a run for a record high. The NASDAQ 100 did close at a record high, and oil has erased pretty much all its gains since the conflict broke out on June 13th. Romaine?
All right, let's get back to those earnings out of Fedex. The shares moving lower here in the after-hours trade for the most recent quarter, the fourth quarter. The company did beat on several key metrics, including adjusted EPS and revenue, which came in at about $22.2 billion. That was growth, though, of only about a half a percentage point. The company said that for the first quarter, it expects revenue growth to be flat to up 2%. Though it did provide an EPS forecast that the top end of that range, slightly below the average of street estimates. And more importantly, the company said right now, because of uncertain global demand, is just not confident enough in providing a full year profit outlook. Craig Fuller is the founder and CEO of Freightwaves, a supply chain intelligence platform, and he joins us right now. And Craig, I do want to start off with the lack of full year forecast and the reasons that FedEx gives, which is because of an uncertain global demand environment. In your role, you get a firsthand look at what that demand is. What is the demand right now?
Yeah, it's quite uncertain. So I think the volatility that we're seeing in the logistics market is in many ways unprecedented. It can be compared to COVID, but a lot of uncertainty caused by policy decisions. So really the war, because of the fact that it looks, at least at this point, contained, it's less of a factor. And really what we're looking at is just U.S. trade policy, how it impacts the rest of the world, how they respond to it. We have the Liberation Day tariffs that are effectively on hold right now, but that date is soon coming, July 9th. We're looking at what happens after that. The expectation, at least from our perspective, is that the administration extends the pause, which will provide some relief, but still create a level of uncertainty that's hard for companies to make investments in this kind of climate.
Well, that's what I'm curious about, too, because, I mean, if there is sort of an additional pause, that almost to a certain extent for certain folks in the market would be a negative. There's also recent commentary out of the Europeans saying that even if Trump goes to those baseline tariff rates, that would still merit retaliation in the eyes of Europe. So there's still a lot of questions here about what you're going to pay as an importer, and for that matter, potentially as an exporter, and more importantly, what consumers end up paying at the shelves. Is this going to be something that's driven much more by sentiment and fear rather than the actual numbers themselves?
Yeah, I think it's a sentiment question, and it's an investing question, capital expenditures, it's an inventory question. The inflation data, we're not seeing big inflationary impacts due to tariffs. There's been some of this in the producer price where you see it in some upstream, but there's also a lot of products, when you look at the overall inflation number, there's a lot of products that we consume here, and in some ways the trade war actually helps lower the cost of that, specifically in things like food and agricultural products, as well as in energy. We produce so much of it domestically. And in some cases, particularly in the ag markets, we've lost some of our export markets, which has actually created a deflationary impact to grocery items. I think one of the biggest factors that perhaps isn't appreciated, we see it in our freight data, is that in many ways this trade war and the uncertainty is a demand destructive environment. And so what is actually happening is that we're not seeing inflation because demand is being destroyed, potential pent-up demand where the economy would be driving more goods consumption isn't happening because companies and even consumers have pulled back their spending in an uncertain environment.
So how does that affect the spinoff of the freight business? Because it's not just FedEx that's doing that. UPS did it as well in 2021. Of course, that was before all of this really percolated. But I'm curious what the timing with all the uncertainty means for this spinoff and how much FedEx can benefit from it.
Yeah, I think quite a bit. I mean, this is probably a 2026 question for FedEx's LTL business. LTO is a very relative to trucking. It's an attractive asset. There's going to be a lot of potential interest in that. I think most interesting is if you look at the trade delta, FedEx wants 10 times earnings. If you look at Old Dominion, the best in class operator trades at 18 times earnings. And so when you think about the opportunity of what FedEx can do with that asset, it's probably going to be priced appropriately. I think FedEx is in a process of really optimizing its unit economics. It's got a lot of work to do there, the cost cutting. Trucking as a business tends to be far more commoditized than the sort of duopoly or triopoly that FedEx enjoys in its core parcel business. And so getting away from the more commoditized trucking part and focusing on their core parcel business, I think is a net positive for FedEx investors.
So we hit upon the big themes here for FedEx. Romain touched on the macro conditions and the uncertainty in terms of demand for parcel delivery. And of course, we talked about the freight business that's going to be spun off. At the end of the day, for investors, this is very much a cost-cutting story. And I feel like FedEx has been cutting costs for years now. How much more room does it have to cut costs?
It's a big question, and Fred Smith is an idol. I've always looked up to Fred Smith as a logistics champion and fan. I think the founder, passing away will actually give some room for FedEx to be more aggressive potentially with the cost cuts, because even though he stepped out of an operational role, he still was a very powerful force inside of the FedEx organization. And so in some ways, it may provide a more blank slate for the company to take more aggressive cost cuts than perhaps they otherwise would have. And so I think in some ways it's all about cost cuts, but in some ways Fred Smith's passing may give management a little bit more freedom, a little bit more autonomy to go make the decisions that they need to make without worried about sort of destroying some of the institutional inertia that may have been built into the FedEx business model from a founder-led company.
Yeah, well said. Craig, we only have about a minute left. I just want to get your thoughts real quickly on this idea of last mile delivery and sort of the fight around that. And I know FedEx to a certain extent was trying to, or excuse me, UPS was trying to extricate itself from that. FedEx to a certain point too. Who is going to fill that role? Do you think it will be the big freight companies like FedEx, UPS? Will it be Amazon, or will it be something in between?
I mean, Amazon is coming on fast and furious. They have, they're running more volume than FedEx and UPS. And so I think that we're going to see this as really a three-party play. I mean, FedEx is not giving up, is not planning to give up the last mile, neither is UPS, but they are losing some share to Amazon. Competing against Amazon is very difficult for these businesses. FedEx and UPS have to make money on every single part of their logistics transactions, and Amazon, and fortunately for their case, doesn't have to actually do that. And so in some ways it creates a much more competitive and contested environment, and that is why I think some of the challenges that we're currently seeing in FedEx and have seen with UPS are starting to bear fruit, because you have this new competitor which is outbuying share effectively, that is competing on a completely different set of constraints.
Craig, really appreciate your joining us today. Craig Fuller is founder and CEO of Freightwaves. Coming up on The Close, a blistering heat wave straining power grids across the U.S. We're going to discuss next. Romaine, did you step outside today?
I did.
And?
I walked real slow and I stayed on the shady side of the street. And kudos to that woman with the fan. I need one of those before we leave. This is Bloomberg.
A power emergency in the U.S. Southeast as a scorching heat wave strains grids across the country. This order allowing Duke Energy to exceed some pollution limits and take other steps to increase power generation amid soaring demand. Joining us now to discuss is Bloomberg's Josh Saul, who covers the power sector, and it's not just the Southeast, the Northeast, pretty hot as well. Josh, how do utilities prepare for these high demand days?
Well, there's long-term preparation, building more power plants, building more transmission. And then there's short-term prep where they tell customers, hey, maybe you don't need to have all your air conditioners on. Maybe you can run the dishwasher at night, different types of conservation like that. But yeah, it's been really hot and really hard on the grid. Here in New York, Central Park had a high of 99 degrees. It's a record going back to 1888 when Grover Cleveland was president. And then down in North Carolina, they also had a high of 99. But with the humidity down there, it felt like 112. So that's putting a lot of stress on the grid there.
Yeah, a lot of hay has been made about the fact that it's actually hotter in New York City today by a couple degrees than Death Valley, which is typically the hottest place on earth. I should also point out, I mean, I live in a New York City apartment building. When I came home yesterday, they had all the lights in the lobby turned off. A couple of elevators were shut down to conserve energy. It gets to this idea as to when you look regionally on a city by city or kind of state by state basis, are there certain regions that are more prepared for the taxing of the grid?
Certain regions are more prepared. I think that when the heat hits, it taxes any area, whether it's Southern California or New York. We saw the 6,000 people, 6,000 customers with blackouts in parts of New York City yesterday. So I think when the heat really hits, all the air conditioners turn on, and it can even make it harder for power plants to operate. There's no region that's immune.
And there were some blackouts in this area too, right? Is that the case across the Southeast as well?
There have not been blackouts in the Southeast. I actually just talked to Duke, and they said that they have adequate supply, adequate electricity for their customers right now. So no blackouts are planned, or no blackouts are planned.
All right. And the good news, of course, is that at least we're expecting in the next 48 hours to maybe get a little bit of relief here in the Northeast with some rain that might get rid of some of the heat. Josh Saul of Bloomberg, keeping an eye here on the heat wave sweeping across the United States of America.
All right, let's go now to the top three, where we name drop some of the people driving the day's most talked about stories. And first up is Boaz Weinstein, the hedge fund manager, revealing how a secret blackjack skill can inform important lessons about risk on Wall Street. Take a listen.
The reason blackjack is very similar to what I'm doing in closed-end funds is what I love about closed-end funds is I know the counts. There's the counts in blackjack, there's the discounts in closed-end funds. We're sitting right now at flat count, actually. When there's a discount, the investor has an edge. And in blackjack, when there's big cards to come, the player has an edge. And so we know what the edge is. In blackjack, we know what the odds are. In closed-end funds, there's uncertainty, but we know how cheap we're buying something.
He's talking about accounts and discounts. I thought he was going to talk about his poker face.
Yeah, interesting. You can, of course, check the latest episode of Bullish there with Boaz Weinstein. That airs tonight at 6 p.m. Eastern Time, right here on Bloomberg Television. Another person we're keeping an eye on is J.B. Pritzker. Of course, he is the two-time governor over in the state of Illinois. And now people familiar with the situation are saying that he is prepared to announce a run for a third term as governor. And this is significant because a lot of folks thought he would actually be on the potentially presidential ticket in 2028. Not to say that if he gets reelected as governor, he still can't do that.
Yeah, I was just going to say, he could still do that. Yeah. It's just a lot of campaigning in a very short amount of time.
Yeah.
But he's got the funds to do it as well.
He is a billionaire.
All right.
Several times over.
All right, let's stay with politics because third on the docket is Congressman Robert Garcia. The 47-year-old Californian will be the next top Democrat on the House Oversight Committee. It's a sign that the Democratic Party may be starting to favor younger voices over seniority in leadership positions. And this is interesting because this was the role that AOC was running for and then ended up ceding.
Yeah, it'll be interesting to see. The Democratic Party obviously has a lot to sort out here when it comes to leadership. And maybe this is a sign of where they might go, or maybe this is just a one-off. When we come back, we're going to talk more about geopolitics, more about the United States, and whether they've actually dealt as much damage as we thought with those strikes on Iran. A conversation with former State Department official Mark Kimmitt. That's coming up next here on The Close.
I'm really unhappy if Israel's going out this morning because the one rocket that didn't land, that was shot, perhaps by mistake, that didn't land. I'm not happy about that. You know what? We basically have two countries that have been fighting so long and so hard that they don't know what the they're doing. Do you understand that?
A fragile truce between Iran and Israel. You heard it there, the frustration in the voice of the President of the United States as he departed the White House, headed for The Hague, the Netherlands, for that NATO summit. That NATO summit now underway. Our very own Anne-Marie Horton is on the ground out there right now. I know that we saw President Trump walking into that building just a little while ago. The big topics of conversation, I thought it was going to be Ukraine, Russia heading into this. I thought it was going to be NATO defense spending heading into this. Is that still going to be the topic of conversation, or is it going to be the Middle East?
Well, they're certainly going to be on the agenda, especially given the fact that this is taking place in Europe, and Europe is still dealing with a war on the continent. And this is something that we heard Emmanuel Macron and the Chancellor of Germany, Friedrich Merz, talk about in an FT piece, talking about the fact that they want to have this NATO defense spending specifically as well, because some of their allies are preoccupied with other issues and they want to make sure that they can fend off Russia. But really, obviously, the whole day started with this frustration from the president himself with the ceasefire he brokered in the last 24 hours that's on fragile footing. And he's clearly incredibly frustrated with both Iran and Israel. He did have a call this morning with Benjamin Netanyahu. Some firm words were spoken. It did seem like at the moment the ceasefire is holding, but it is fragile and it is vulnerable. And that is why that is this overhang at this NATO summit. The president's going to be also walking into two very different viewpoints. If you take Macron and what he had to say about the U.S. strikes, he doesn't think they're on legal footing. He thinks they were illegal, even if he agrees with the United States that Iran cannot have nuclear capabilities. And then you have individuals like the German chancellor who says that Israel is doing the, quote, dirty work for the rest of the world to keep the region safe, and said, I really shouldn't have an opinion about what the United States and Israel did vis-a-vis Iran. So that's the perception the president is going to be. A lot of mixed feelings when it comes to this, but this is just another geopolitical uncertainty that this group has to deal with.
And of course, the Secretary General of NATO, Mark Rutte, has geared this whole summit towards getting President Trump to renew his commitment to honor the Article 5 of NATO that commits the alliance to mutual defense. How's he doing on that front? Because Trump didn't necessarily make comments that sounded like he was backing up that idea.
He was incredibly ambiguous about it, and we've seen this before with the president of the United States, Donald Trump, in his last term, and also when he was running for re-election for this last previous election. The president was asked about it, and he says, well, it depends how you define Article 5. And then he went on to tell the reporter, as he was on Air Force One, his way over the Atlantic to The Hague, that he would give a, quote, exact definition of Article 5 when he is here. Obviously, Mark Rutte, and you can see this this transparently in a text message that he sent to the president. The president decided to release to the world that he was really gearing the entire summit towards meeting the demands of this administration. I wrote a year ago in July during the Republican National Convention how foreign policy advisors to then candidate Donald Trump were talking about how they wanted to really try to assuage NATO and convince them that they would have to spend more of their GDP towards defense. And Mark Rutte was able to get this 5%. It's a little bit ambiguous in the sense that they have 10 years to get there, and part of it can be used for hardcore defense, and other part of it to get to that 5% can be used for in industry and border patrols and cybersecurity. So a little bit more leeway for some of these countries, but they really were trying to do this. And the one commitment he definitely wants is Article 5, mutual defense. If you attack one country, you attack us all. And the president left that very ambiguous walking into this meeting.
Yeah, and of course, it's something that we'll continue to monitor any comments that he does make on that front. Anne-Marie, thank you so much. Anne-Marie Hordern, of course, Bloomberg Surveillance co-host, reporting live from The Hague, where President Trump is. Now, there are reports surfacing that U.S. strikes over the weekend only set back Iran's nuclear program by a few months. According to the New York Times and CNN, the targeted facilities were not completely destroyed. So for more on what comes next, let's bring in General Mark Kimmitt. He's the former Assistant Secretary of State for Political Military Affairs. General, thank you for speaking with us again. I want to get your take on these reports, which indicate that the strikes really only set back Iran's nuclear program by less than 6 months. In addition to the fact that the reporting shows the stockpile of enriched uranium was moved before the strikes to secret locations. What's your reaction?
Yeah, well, two things. First of all, I'm not going to believe any number I hear till I hear it from the formal battle damage assessment that's done by the Joint Staff and by the military. I think General Kane was on target on Sunday when he didn't use terms like obliterated, this, that, the other thing. He used the term significantly damaged. Now, I don't know where these reports of 6 months are. I'm not sure anybody's been on the ground to see what's happening inside there. So I just want to wait and see what the experts have to say. What's next? It's clear what's next. On the issue that you brought up about the uranium, look, if the enrichment facilities have all been destroyed or heavily damaged, the uranium that wasn't there was only enriched to 60%. To weaponize it, you got to get it to 90%. To get it to 90%, you have to have enrichment facilities. The enrichment facilities were significantly damaged.
Thank you for answering that. I'm curious, when we look at what is in place right now, which is this fragile ceasefire, we're not sure if it's going to hold. It seems like it's held so far today, if you look at the market reaction. Is this a normal ceasefire where both sides formally agreed to it, or was this manufactured by the president? He seized the moment of Iran's largely symbolic retaliatory attack on the U.S. airbase in Qatar to declare a ceasefire on behalf of the two nations.
Well, first of all, both nations have said they now accept the ceasefire. Was it manufactured by Donald Trump? Oh, absolutely. And I would also note that Donald Trump today, when he talked in such visceral and foul-mouthed terms, used language that hasn't been used in a generation that I'm aware of against Israel and Iran. And that's good. He treated them like little boys that were acting up, and that's good. We didn't have terms like we would normally hear. We're trying to call on all parties to come back to the ceasefire. There weren't private calls between nations in the White House that we never hear anything about. There weren't letters exchanged between the Swiss embassy and Iran. You had a guy who not only made the deal, but now is guarantor of the deal, and he owns that deal, and that's why he was the way he was today. I don't think that's language you typically hear taught in the School of Foreign Service, certainly not used in embassies, but it seems to have worked.
So this gets to the point, though. What's next, General, when we talk about this idea of what a negotiation would look like, and more importantly, what the end game would be? I mean, Israel has made it clear what it wants out of Iran, which is basically a total cessation of this nuclear program, and to a certain extent, if you believe some of the comments from Netanyahu, actual regime change. What would the Iranians actually agree to?
Well, let's put aside regime change. I think that's a lot of loose talk coming out of both Israel and the United States. We have a situation now where a significant portion of the Iranian nuclear program has either been set back or heavily damaged. We've got to get to the point in the negotiations where the Iranians abandon the entire nuclear program. People say they have a legitimate right. Look, you have a legitimate right to drive a car, but if you spend most of your time driving that car excessively and nearly killing people, you're going to get your driver's license taken away. It's a very simple metaphor, but the fact remains they say they have the right, but they have demonstrated that they're not trustworthy with that right. So I'm sure Steve Witkoff and the team are coming in and saying, look, you no longer have any leverage. You need to dismantle your program. If you dismantle your program, we'll talk about lifting sanctions, economic assistance, financial assistance. I think that's the going-in position.
Do you think, though, that the Iranians, at least the current regime that is in place, would actually agree to that?
Probably not, but that's where you start the negotiations from. And candidly, what leverage do the Iranians have now?
Well, they have nuclear weapons, or at least nuclear capabilities, right?
No, they don't. That's the whole point. They perhaps have some weaponized uranium at some place, but right now they don't. The estimates are they have perhaps enough for 1 or 2 weapons, but you can bet that Mossad and the CIA are certainly trying to track that down. They're killing the nuclear scientists. They're dismantling their electronics and their centrifuges. So I think that right now, Iran is in a very precarious position. The leverage they think they have, they probably don't have, certainly not as much as they had 3 weeks ago. So hopefully they will come as reasonable people to the negotiating table. That's not what Iranians typically do. But let's see how tough we can be on them.
I want to get your sense of what you think about how investors are reacting. I'm not asking you to be a market analyst, but you have stocks rising and the NASDAQ 100 closing at a record high, oil prices tumbling for a second straight day. And on this idea of President Trump saying that he wants to keep oil flowing out of Iran, is this an appropriate reaction? Are traders and investors being too optimistic, or does it seem reasonable to you?
Look, I think we all know money is a coward. The fact remains is if the markets believed that there was a high chance that this would blow up even more, for example, Iran trying to knock out the Straits of Hormuz, trying to do a terrorist attack, use a dirty bomb, I think that the markets would have absorbed that by now, which tells me they believe that to be a very, very low probability. The fact remains there's always a black swan event just around the corner, so it could. But I think at this point, the markets are telling us, whether they're right or wrong, but the markets are telling us that they seem to be generally okay with what they're seeing happening on the ground.
All right. We always appreciate you taking time for us, General. That's Mark Kimmitt, former Assistant Secretary of State for Political Military Affairs here in the U.S., as we continue to monitor the developments in the Iran-Israel conflict.
And as we mentioned, stocks finishing higher on the day, pretty much near their session highs. They just came off a little bit in the final, 5 to 10 minutes of trading. The NASDAQ 100 closing at a record high. The S&P 500, 92 points above that 6,000 level. And yields continuing to fall as well. We've got more auctions later on this week, the belly of the curve. And Romain, the big mover here is oil prices. NYMEX crude now below $65 a barrel, pretty much giving back all of its gains since the June 13th strikes.
Well, all of them. In fact, it's well below where it was even prior to June 12th, which I think says a lot here about where the market's mentality is at, with NYMEX crude below 65 and, of course, Brent crude back at that 67 level. And don't forget, the VIX actually fell today by 2 points. It's back below 18 here. This is The Close on Bloomberg. Well, after a relative few days of relative strength for the dollar, it's back on the back foot, down about a half a percentage point on the day, at least as measured by the Bloomberg Dollar Index, leading to year-to-date declines now of about 10% for the dollar. Our next guest says that the dollar is not the world's strongest currency and, quite frankly, hasn't been for decades. That title actually goes to the Swiss franc. Ruchir Sharma joins us right now. He's the founder and CIO of Breakout Capital and the chairman of Rockefeller International. Ruchir, I do want to start with the dollar. We've been talking all year long about the weakness that we've been seeing in the dollar. And you wrote a great column in the Financial Times a couple of weeks ago that kind of talked about this idea how the dollar really hasn't been as strong as maybe we perceived it to be, at least relative to things like the Swiss franc. And more importantly, this idea that some of the devaluation that we saw, or we thought we saw, in East Asian currencies maybe wasn't quite the devaluation story that dollar bulls thought it was.
Well, the main point I was trying to make in that column was this, which is that the current administration and a lot of current policymakers are in awe of what East Asia achieved. They thought that countries like China and other countries sort of devalued their way to prosperity. And so therefore this thinking has sort of risen that maybe the dollar, from its very lofty perch, the dollar has been very strong over the past few years. Maybe the dollar needs to fall to try and help U.S. manufacturing and to help U.S. exports. What I said in that column is that if you look at the last 10, 20, 30, 50 years, the strongest currency in the world, in fact, has been the Swiss franc. It's been even stronger than the dollar. And the Swiss have been able to cope with a strong currency by even increasing their share of global exports. So how have the Swiss done that, and what lessons can you learn in a place like America from that? And I think I had two main lessons of this. One, that for very rich countries or high-income countries, having a cheap currency is really not that beneficial because they don't produce those kind of low-margin goods where the currency valuations may matter. They produce much more high-end goods, and that's what Switzerland has done, that it produces very high-end goods which are competitive at even a very so-called expensive exchange rate. So this idea that America needs to have a weak currency and that's going to help its exports and help manufacturing come back here is a bit of a myth if you look at what Switzerland has been able to do, which may be a more relevant example, and that rich countries are not able to use the currency as a tool so much. And the focus instead needs to be on making very productive, high-end goods, which are not that sensitive to currency movements.
So the weakness that we've seen in the dollar has probably been more by circumstance than design, at least this year.
Right.
It gets also to the question, too, about the haven aspect of it. And when you look at all the turmoil going on overseas, in the Middle East, particularly over the last couple of weeks, there was a lot of questions about how much of a haven bid we would see to the dollar. We did see some, probably saw a little bit more into the franc and even into the yen and some other currencies as well. Do you think the dollar, though, given the prominence of the world's largest economy and its importance, will still remain kind of one of the primary haven assets?
Yeah, I think, like a lot of people confuse two issues here. One is the reserve currency role, the so-called safe haven role of the dollar, and two is just the dollar's valuation. Because if you look at it, the dollar has been the world's reserve currency now for about 100 years or so. 50 of those years since the demise of the Bretton Woods system, it's been a freely floating currency, right? And it's still been the world's reserve currency. Now, that does not mean that the dollar always goes up. Because if you look at those 50 years, you've had bull and bear markets. In fact, the dollar on a trade-weighted basis has been in a range of plus minus 15% in general against most currencies. So now, every time the dollar weakens, the fear that goes up is that, oh, maybe the dollar is about to lose its reserve currency status. Maybe it is, but those are two separate issues. It is perfectly consistent with history that the dollar could decline by 30 or 40%. And yet, that would be consistent with what's happened in the past 3 bear markets that the dollar has had, while remaining the world's reserve currency. That if you look at the 1970s, and then even as recently as the 2000s, the dollar euro, for example, declined, I think, from an exchange rate of well below 1. And the dollar depreciated to an exchange rate of more than 1.4 against the euro, a very sizable move over a number of years in the 2000s. And yet it did not lose its reserve currency status. So these two things have to be distinguished. What I feel currently is that the dollar began from a point of being very overvalued, and that overvaluation is now being corrected. By any chance, if there's a threat to the dollar's reserve currency status,
separate,
then that's a separate issue, but then the decline could be much greater than that. And there are some signs that the dollar's reserve currency status is sort of being freed, with gold increasing now in FX reserves and the dollar's share going down. But these are very long-term trends. And let's not confuse these long-term trends with the fact that the dollar is very overvalued and could depreciate and yet remain the world's reserve currency.
Well, speaking of long-term trends and countries that have benefited from a weak currency, I want to ask you about China, because the conventional wisdom is that it needs to rebalance its economy away from export and investment towards consumer spending. You say the consumption side is doing actually just fine. And in fact, it's the investment side that has grown very quickly. In fact, so quickly that China has reached overinvestment, and it makes the consumption side look like it's flailing when it's not. Can you explain that?
Yeah, so I think this is a math which a lot of people, I think, have fallen for. Why do people say that China is not consuming enough? Because in China, consumption as a share of GDP is only about 40%. For most countries in the world, particularly of China's per capita income level,
it's the majority.
Yeah, the number is well above 50%. So you look at China and say that consumption as a share of GDP is only 40%, so China is under consuming. The point that I'm making here is this, that if you look at China's consumption growth independently, not as a share of GDP, what the growth rate has been, that growth rate this century has been very rapid. It has slowed down in the last few years, but it's still relatively high compared to other countries. But investment in China has grown at a pace which is so fast and for such an extraordinarily long period of time that I think that a lot of people confuse this issue. So investment as a share of GDP in China is extraordinarily high. But if you were to normalize, if investment growth in China were to slow down like it should for a country of that per capita income and how much has already been built, then consumption as a share of GDP will not appear to be this low. So I think that this is a bit of a fallacy that most people fall for by looking at consumption and investment as a share of GDP rather than looking at their growth rates independently.
All right, Ruchir, we have to leave it there. Always a great discussion. Ruchir Sharma is the founder and CIO of Breakout Capital, the chairman of Rockefeller International, and the author of What Went Wrong with Capitalism. Stick with us. We'll be back in a moment. This is Bloomberg. All right, let's take a look at what the markets are going to have their eyes on over the next 24 hours, and that includes some earnings before and after the bell tomorrow.
We're going to hear from Micron and, of course, what kind of demand there is for its high bandwidth memory chips. So it's a read on AI, certainly, and General Mills, consumer staple.
Yeah, there's some chips there, too, I think.
Yes, that's right.
As well, a different type of chip here. So a read on the consumer and maybe a read on business spending as well. We're going to get some economic data as well, and we're going to start with new home sales.
Yeah, new home sales for the month of May expected to drop about 6.7%. Affordability certainly remains an issue here with interest rates. As long as the Fed doesn't cut rates, still pretty elevated.
So we get those monthly numbers. We also get the weekly mortgage application numbers that might actually shed some light as well on the health of the market. And then day two for Jay Powell on Capitol Hill.
This time before the Senate Finance Committee, of course, he didn't make any news, which is exactly what he wanted to do.
Absolutely here. And usually it'll be a repeat of what we heard the day before. We also get an interesting bond auction tomorrow.
The 5-year. And of course, we know that the belly of the curve has been in great demand, especially at the shorter end. So we'll see how that plays out. 2-year was pretty good today.
Yeah, the 2-year was decent today. And of course, tomorrow, day two of the Nato Summit in the Netherlands. Of course, we will have full coverage on anything that comes out of that. In the meantime, stick around. Balance of Power will have more coverage of what's going on overseas. We'll be back tomorrow right here on The Close on Bloomberg.